Let us continue with section 90, bilateral relief. Bilateral relief means I have already told you, government of two countries, government of India and government of foreign country, they will meet and they will sign the agreement, which is also known as the tax treaty, which is also known as the DTAA agreement. Okay, double taxation avoidance agreement. Section 90 provides that central government may enter, not state government. It's always job of a central government, may enter into an agreement with the government of any country outside India or a specified territory outside India. So why this particular language is written specified territory? So the foreign country or foreign territory, geographical territory may not be the country, it can be an island, and therefore this particular language is used for granting of relief in respect of income on which, please understand, very important, here we are going to learn purposes of DTAA. One of the purpose of DTAA is to grant relief from double taxation, but that's one of the purpose. Please understand, there are many aspects to DTAA that you are going to learn here. Income on which income tax has been paid in the both in India and in that country or specified territory, or income is chargeable under this act and under the corresponding law in the force of that country or specified territory to promote a mutual economic relations, trade and investment. So obviously you have to develop the relation between two countries, therefore you will grant the relief. So there will be a tax exemption method or there will be tax credit method, but definitely a relief will be provided for doubly tax income, but that's one point of it. Now please understand, DTAAs are also misused. I'm very much clear about my word. You know that if you are investing in Indian capital market, obviously it is taxable in India. So from USA, if you are investing in India, taxable in India. From Canada, you are investing in India, taxable in India. From Dubai, you are investing in India, taxable in India. From India, you are investing in India, taxable in India. Please understand this. But from Mauritius, if you invest in India, according to the earlier DTAA, now the DTAA has been taken care of, but according to earlier DTAA, I am telling you, this DTAA says the capital gain tax will be charged in the country of Mauritius and not India, and Mauritius was not having any capital gain tax, or even if they had the capital gain tax, it was negligible, not comparable to India. Now, the benefit was provided to Mauritius entities. Very, very important. The benefit was provided only to the Mauritius entities or citizens of Mauritius. But what USA, Canada and Dubai people have started doing, they started opening one unit here, okay, maybe one organization, and that organization will invest into India. Meaning thereby now global player started coming to India through Mauritius route to misuse the DTAA of India Mauritius and avoid the tax. Not only that, many Indians, rich class people, they went to the Mauritius, they open a branch there or entity there, and from Mauritius they invested into India. Indians went to the Mauritius and through Mauritius they came to India because they knew that if we invest in India through India, taxable. If we invest in India through Mauritius, not taxable. Don't you think, my dear friend, this is a misuse of the treaty? And it's not only India which has been exploited like this. Global countries, big corporates have exploited tax system like anything, not only in India but globally. So we had that G20 summit, where all the countries will come and they will discuss their issues on the taxation, and they came up with an idea that let us modify domestic taxes of respective country. Every country should modify their own domestic taxes, and now they should provide that there should not be double relief and there should not be double taxation. For double taxation relief, already law was there, now there should not be misuse, and for that they have amended the law in Finance Act 2020 in India. Very, very important paragraph, my dear friends. For avoidance of double taxation of income under this act and under the corresponding law in that country or specified territory. Okay, sir. So we have to avoid double taxation without creating, look at the amendment, without creating, we have to sign an agreement in such a way that there should not be double taxation, but without creating opportunities for non-taxation. Without creating, it should not happen that it is neither taxable in India nor taxable in a foreign country. One of the countries should be eligible to collect taxes on that particular income. without creating opportunity for non-taxation or reduced taxation through the tax evasion or tax avoidance. So that should not happen. So this is the amendment, including through treaty shopping. Just now I have given you example of Mauritius, that is known as the treaty shopping. You find a treaty, you find a tax haven, and you enter into global market through tax haven to avoid your tax matters. Including through treaty shopping arrangement aim at obtaining relief provided in the said agreement for the indirect benefit to the resident of any other country or a territory. So that should not happen. If a benefit is created and if Mauritius people are enjoying that benefit, that's fine. But if other countries are also taking that benefit, then that's not acceptable. The third and most important, you know that many people used to have their account in Swiss bank, and Modi government specifically, when they came into power, they said, now we are going to gather data from all the countries and we will see which Indians have stacked their black money outside India, and all many things have happened. So DTAA provides for exchange of information. It is not only double taxation relief, but one country agrees with another country. You provide information to us, we will provide information to you. So it's mutual agreement that we will definitely share the information with each another, and Switzerland has signed this particular DTAA now, that they are ready to share the information. Therefore, it's no more, Swiss bank is no more secured for Indians to park their money in Switzerland. Okay, earlier it was there, but right now they don't have this particular power. Next one, D, recovery of income tax. So if somebody has defaulted in income tax and is living in that country, then we have to recover. Obviously, Indian officers cannot go in foreign country and conduct the operation. So Indian income tax officer will put a request to the foreign income tax authorities, and foreign income tax authorities will recover money from the citizen which who is residing there now and who has defaulted in India, and they will give the money. Same thing we will do for that foreign country. If any foreign country's resident or citizen has come to India after evading tax in that respective country, then India will make all possible efforts to recover the tax and hand it over to the foreign country. Where central government has entered into such agreement with the government of country outside India or specified territory outside India for granting relief of tax or for avoidance of double taxation, then in relation to the assessee to whom such agreement applies, the provision of this shall apply to the extent they are more beneficial to the assessee. So in India and in DTAA, what assessee should follow? Because in India, Indian Income Tax Act, different provisions are written, and in DTAA different provisions are written. This assessee is confused. Which one I should follow? Okay, so we always say whatever is more beneficial. Now, if for transaction 1, say for example for capital gain, DTAA is more beneficial, but for IFHP, please understand, for IFHP, income tax India is more beneficial. Sir, can he do so? Can he opt DTAA benefit for capital gain transaction and income from house property as per Indian income tax? Answer is yes, because there is no restriction that once you opt for DTAA provisions, you should always follow DTAA provisions, or it is also not written in the law. Once you accept the income tax provisions, income tax India provisions by ignoring DTAA, then you have to stay with Indian Income Tax Act. It's not like that. In fact, in capital gain chapter also, you can choose a different method for different transaction. You sold a land, you think that DTAA is more beneficial, you follow the DTAA. You sold shares, you feel Indian Income Tax Act is more beneficial, you can follow Indian Income Tax Act, because ultimately the choice is yours. This law is created for the assessee who has suffered double taxation. Therefore, we are saying whatever is more beneficial to you, you can adopt. But when we are giving you this kind of freedom, do not abuse Indian income tax law. Many people have already abused. We don't want more tax abuser, tax avoiders. No. So therefore, India has created GAAR, that means General Anti-Avoidance Rule. Please understand, General Anti-Avoidance Rule overrides DTAA as well as income tax law. Okay. So this is applicable. GAAR are applicable even when you opt DTAA. When DTAA under section 90 are intended to provide relief to the taxpayer who is the resident of the one of the contracting country. Contracting country means, say for Canada, so Canada will become contracting country to the agreement. Such a taxpayer can claim relief by applying the beneficial provisions either by the treaty or the domestic law. However, in many cases, taxpayers who were not resident of the contracting country, I told you, many foreigners were also taking benefit of the DTAA by creating one office there, also resorted to claiming the benefit under the agreement entered into by Indian government with the government of the foreign country in effect of the third party resident. Third party resident means not original resident, not resident of Mauritius, resident of other countries, claim the unintended benefit of the treaty. This has happened. They are telling you the problem. It was unintended. Intention was only to give benefit to the Mauritius people, but many global players have started taking the benefit. That was not an intention of the DTAA. Therefore, section 90 subsection 4 provide that non-resident to whom the agreement referred in section 90 subsection 1 applies shall be allowed to claim the relief only if he provides the tax residency certificate. Now, we cannot go there and cross-check each and every resident, whether he is a genuine resident or not. So, if you wanted to enjoy the benefit of the Mauritius treaty, you have to provide us tax residency certificate from the Mauritius tax authorities. Okay, so we are not bothered whether you are genuine resident or not. You obtain the TRC from that country and you submit, then only DTAA benefit will be granted to the assessee. This is done to reduce the compliance burden on income tax department. Also in section 91 provide that treaties shall not be used for claiming the reduced taxation through tax evasion or tax avoidance, including treaty shopping. This what we have already learned, that it is not possible now to avoid taxation by using the by misusing the treaty. Therefore, a certificate issued by the country of government of a foreign country would constitute a proof of tax residency without further conditions regarding furnishing the prescribed particulars therein. In addition to such certificate issued by the foreign government, assessee would be required to provide such other document and information as may be prescribed. So they always demand few more documents like passport. They can ask you to provide. They may also ask you to provide the unique identification number or unique tax identification numbers of your country, a permanent resident address in that foreign country. So some other information definitely we can ask. Charge of tax in respect of the foreign company at a rate higher than, very important, mark it, very important. Okay, this is very important aspect. One of the clause of DTAA says, please understand, one of the clause, DTAA has many articles. One of the articles says you do whatever you wanted to do, but if you are providing benefit to domestic company and foreign company, please understand, the laws that whatever law you have wanted to make, you make, DTAA or Income Tax Act, but the laws in regarding to foreign company cannot be unfavorable as compared to domestic company. This is the general rule, thumb rule. Every country follows that. Whatever laws you are having for your own companies and the laws that you are having for foreign companies cannot be discriminatory in the nature. Please understand, if you are providing benefit to domestic company, you must also provide benefit to foreign company. You cannot do discrimination with the foreign company. This is the fundamentals of DTAA. But India says, okay, we can understand that the laws for Indian company cannot be less favorable than the laws which is made for the foreign company. But also DTAA provide that, you know that the domestic company's tax rate, highest tax rate in India is 30%. The foreign company's tax rate is 40%. This is completely unfavorable. So India puts one of the clause in every DTAA. In every DTAA, India will have one common clause, and this is that clause. Very important clause, my dear friend. The thumb rule says laws for foreign company cannot be less favorable as compared to laws for domestic company, but please understand, the charge of the tax in respect of the foreign company at a rate higher than the rate at which a domestic company is chargeable shall not be regarded as less favorable. You cannot assume it as a less favorable, and based on this particular clause, our institute have targeted a question. We have to answer that question. So foreign companies having higher tax rate and Indian companies having lower tax rate, you should not consider this as a less favorable. This is the clause which we expressly put in our DTAA. Yeah, apart from tax rate, if anything happens, then we will take care of that. But tax rates, we wanted to keep in this manner itself. Okay. CBDT circular provide that specific provisions of DTAA will prevail over general provisions of Income Tax Act. So you should know the hierarchy. in the basically you should know the Income Tax Act. DTAA overrides Income Tax Act, but GAAR, General Anti-Avoidance Rule, overrides DTAA. So this is the hierarchy, you keep it in mind. However, no specific provision in the treaty, then Income Tax Act will apply. Generally, DTAA only provides for distribution of taxing right between the resident and the source state. The computation mechanism is usually not provided in DTAA. So computation mechanism, obviously you have to opt from respective country's law, not Indian income tax. For India, India will compute the income. For foreign, foreign will compute the income. Notification issued by CBDT state that income of a resident of India may be taxed in other country. So this is again, they are providing you the same paragraph, they are providing you the same logic that yes, resident of India will be liable for even tax in a foreign country because of the source rule. So then what is the solution? This will lead to the double taxation. What is the solution? So solution was discussed in Model Tax Convention, and because of that we signed a lot of treaties. So the format of the treaty, like when you make the audit report, you don't actually draft the audit report. Audit report format is already there. You just modify audit report according to your selection. So in double taxation agreement also, we don't draft double taxation agreements. This OECD model and United Nations model, it is there, already formats are there. Whenever we sign the treaty, according to whether if we are signing the treaty with developed nation, then OECD model is applicable. If you are signing the treaty with some other country, then United Nations model is applicable. And then India can have also a modified model. Please understand, this is just a standard format. It should not be exactly copied and pasted. But majority time to make law simpler and common for lot of foreigners, it should not be more complicated. Therefore, we try to stick with the standard format. Not only we, every foreign country will try to follow either one of the model. And majority provisions of these two models are also common. We will discuss these models when the tax treaty chapter starts. One illustration: examine the correctness or otherwise of the following statement with the reference to provision of Income Tax Act. Double taxation avoiding treaties entered into by the government of India override the domestic law. Definitely it override the domestic law, but it does not override GAAR provision. That note you have to write. It override the domestic law, but it does not override general anti-avoidance rule. Thank you.